Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good और मैं तो हमेशा मस्त ही रहता हूँ. Welcome to episode number 4 of revision cum amendment lectures for May 22 and November 22 exams, previous year 21-22, assessment year 22-23. In the last class, we finished the first part of Charitable Trust chapter till the conditions including the registration we are done. So we will now go ahead from our handwritten book Exemption 2.0. The next thing is calculation of income of the trust. So when we are continuously saying 15% exemption, 15% exemption, how exactly are you going to calculate that? Starting with the computation, we will first take the incomes of the trust, and the first income is any order you can take, but the first income, the most popular income, the main source and biggest source of income for charitable trust. Corpus donations is not a part of donation, so exclude that donation. Corpus will not be included and take all other donations. Donations being the main source of income, donations excluding corpus. Why corpus? Because corpus is not a part of income, so corpus will be excluded. Take all your other donations. Next, take income from property of any kind. It can be not just immovable property. If you have shares, the dividend is property. If you have FD, then the interest is your income from property. Any kind of asset that is generating income, that will be income from property. And then take business income, where we will take direct income minus direct expense. In other words, the gross income we will be taking, but depreciation will not be subtracted because cost of acquisition may be taken as application of income. We are aware that from balance 85% we get deduction of application of income for approved objects, and if we have taken the cost of asset as application, then depreciation will not be allowed. So what are the incomes that we will take in the total? Donation excluding corpus, property of any kind, and gross income from business, and their depreciation will not be subtracted. This total will be called the net income of a charitable trust, net income. And from this net income, we will be eligible to get 15% exemption because 15% is exempt. So from this total, 15% will be exempt. And now from the balance 85%, if you want further exemption, then what are the exemptions available from balance 85? So 15% blanket exemption on your net income. Net income comprises of 3. I'll repeat: donation excluding corpus, property of any kind, and gross income of business. That total is your net income. Take 15% blanket exemption, and balance 85 is taxable. Now, do you want further exemption from the balance 85%? Then one by one. First thing, any amount of application of income towards approved objects, that is any amount spent towards the approved objects, will be allowed as application of income. When we are taking that deduction of application of income, it can be capital or revenue. Both will be allowed. So any purchase of asset will also be allowed, which is why depreciation is not taken. If you have given donation to other trust but not being corpus, because if it is corpus, the other trust will not show it as income. So donation to other trust excluding corpus. Any expense incurred during the year or up to the due date of return filing, you get deduction of all. And while giving this, remember that the PGBP disallowance, that if there is TDS not deducted, then 30%, 100%, cash payment more than 10,000, then those disallowance will be applicable here also. So any amount spent for the approved objects, whether capital or revenue, whether during the year or up to due date of filing return, donation to other trust excluding corpus, all will be allowed, but PGBP disallowances will be invoked. You give these exemptions as application of income towards approved objects. In other words, amount spent for approved objects will be allowed as a deduction. Second thing that we will allow you is any accumulation of income. It is not possible to spend 85% of your income, so you can accumulate for some future big dream, so that accumulation will also be subtracted. Any amount that you have not received only during the year, if you have not received, you will not be able to spend or accumulate, so that will be subtracted. And any amount which is received for any past year, if you are subtracting current year not received, then any amount which is received from a past year, that will get added. And finally, you will arrive at the net taxable total income of the trust. So the summary of computation of income is: first, start with donation excluding corpus. Take the total income, in which we have 3. Donation excluding corpus, we will be taking property income of any kind, and then we will be taking gross income from business, and from this net income we will get 15% exemption. The balance 85 will be taxable, and if you want further exemption, then 1, spend for approved objects. What are the points to be noted? It can be capital or revenue, both will be allowed. It can be during the year or up to due date of return filing. Both can be allowed. Both will be allowed. Donation to other trusts excluding corpus, that will be allowed. And lastly, if there are PGBP violations, then that disallowance will be invoked. Here also, after subtracting application, also subtract accumulation. Any amount not received, subtract that, but any amount received for a past year, you get net income. Here also we have two amendments. Amendment 1. If there is any application of income from any loan or borrowing or from corpus donation, it shall not be treated as application of income. Very simple. If we take a loan, we don't show it as income. Then if that money is spent, then we cannot take it as application of income. If we receive corpus donation, we don't show it as income. So if that money is spent, you cannot take it as application. Any amount spent from corpus donation or loan shall not be treated as application, because we have not shown the receipt as income. If the receipt was not shown as income, then we will not be allowed the application of income. But in any future year, if the amount spent from corpus is invested back into the corpus or the loan is repaid, that means you must have used your other taxable income. Supposingly today I get 5 lakh loan, I don't show that is income, I spend that 5 lakh rupees, I will not get deduction of application, because this loan income was not shown as income. This application benefit will not be. But in future, someday if I repay the loan, that repayment has to be from some other source, from some of my taxable source. The moment I repay this loan, it will be assumed that this money which is actually being repaid as loan, that means this money is being used for my application. It is like I did not have money. I borrow money from my lender and I spend it. I have spent it, but I will not get the benefit of application because it was from loan money or corpus, both. But now from my other taxable sources, if I repay the loan, that means I have used my own money for this expense. Now that I have repaid the loan or repaid the corpus, then in that case, in the year of reinvestment or in the year of repayment, that amount will be treated as application of income. To put it in simple words, money spent from loan, borrowing or corpus is not application. But if that loan is repaid or the corpus is reinvested, then in that year it will be treated as application of income. That's the first amendment. And second amendment, if there is any deficit of earlier years, brought forward loss. Earlier, charitable trusts were allowed to carry forward their losses for unlimited period. But now they say any deficit brought forward shall not be allowed in computing your income. So the concept of deficit is over. So two amendments that have taken place in computation. First amendment, money spent from loan or corpus is not application, but if the loan or corpus is repaid, then it will be application. Second amendment, deficit is not going to be allowed. Let's go to the concept of accumulation of income. Accumulation of income is allowed if you are saving money for some future dream. If you say that you want to do something big in life, अपन को जिंदगी में कुछ बड़ा करना है. If you are saving money for something big, this is sacred games. If you are saving money for something big, then you can take the benefit of accumulation of income. Any trust having a major dream or goal, for example, you want to expand your primary school to secondary school or a dispensary to a hospital, then you should send a request to your assessing officer in form number 10. So, registration of trust will be done with CIT, but this application request, this accumulation request will be sent to your assessing officer in form number 10. This has to be done on or before the due date of filing return. The request has to be sent in form number 10 to the assessing officer on or before the due date of return filing, and only reproduction of object clause will not be allowed. You cannot just copy paste your trust deed, primary objects, secondary objects. You have to tell the AO that, sir, today we have primary school, we wish to start secondary school. Sir, today we have dispensary, we wish to start hospital. You have to tell this to your assessing officer, then only it is going to be allowed. But intimate details like where you will buy the land from, how you will generate money, the intimate details of the project will not be required. You have to just tell him how your future will be different from your present. Now that you have accumulated the amount, you can subtract it in your computation by calling it accumulation, but the accumulation has to be spent within 5 years from the end of the year. So if you accumulate in your exam year 21-22, within 5 years up to 31st March 27, you will have to spend it, and anything which is unspent, whatever is spent is gone. Anything which is unspent till the end of 5 years will be taxable in the very next year, 6th year. So it will be added in the income of the 6th year, no problem. Spend in the 6th year. So it will be treated as application, add and subtract. And in fact, even in the 7th year, if you spend up to due date of return filing, that is also treated as application of the 6th year. So on paper, they tell us that we have 5 years, but effectively we get 6.5 years. 5 years you don't spend, it will get added in the income of the 6th year. Spend in the 6th year. So it will become application. 6th year also you are not able to spend, no problem. 7th year up to due date of return filing of 6th year, then it will be treated as application of 6th year. And accordingly, you end up getting 6.5 years altogether. Same amount need not be accumulated. Your accumulation can be different. Whatever is your savings, on that basis you can set amount separately. So same amount need not be accumulated every year, and you can renew and you can accumulate every year. So every year you save 5 lakh rupees for your dream, keep it aside. Save 5 lakh, keep it aside. You can accumulate every year, and every accumulated amount will get the fresh period of 5 years. The accumulated amount can be spent only for the purpose it was set aside. You can use it only for that purpose, except 2 cases. If AO permits you to use for other purpose, then you will be allowed, and in the year of dissolution, everything has to be given to other trust, so you will not be able to spend, correct? Donation to other trust excluding corpus is allowed as application of income. We saw that in the computation, but it has to be out of your current year income. It cannot be out of accumulations. Otherwise, what people will do? 5 years they will accumulate, then they are not able to spend. They will give it as donation to other trust. So donation to other trust has to be done from your current year income. Donation to other trust from accumulations will not be allowed, except again in the year of dissolution, where everything that you have, all assets, all your accumulations, all your cash balance, everything has to be given to the other trust. So donation to other trust excluding corpus will be only from your current year income, but except in dissolution year, where you can use your accumulations also. Next concept of charitable trust is concept of capital gains. Very easy, because it is basic calculation. Sale minus cost. There is no concept of long term, short term. Once there is no long term, short term, obviously no special rate, no indexation, no 54 series. There is only this one exemption that I have to teach you, that if the amount is invested in another asset. So you are selling one asset, invest in another asset, or you are creating an FD with a minimum duration of 3 years. Another asset or FD with minimum duration of 3 years. Invest in another asset or create FD with minimum duration of 3 years, then we will give you an exemption if entire net sale consideration is invested, entire capital gain is exempt. So till here it is same as NRI taxation, invest net sale consideration. But if entire NSC is not invested, here they do not have the system of proportionate. Proportionate system does not work here. This is a very, very illogical system, and you have to learn it like the way it is. The exemption will be equal to cost of new asset minus cost of old asset. This is the formula. So if you invest your entire net sale consideration, entire capital gain will be exempt. But if not, then the exemption will be cost of new asset minus cost of old asset. To give you an example, gross sale consideration 50 lakh 50,000, transfer expense 50,000. So this is the net sale consideration, this is our cash balance 50 lakh. From this we subtract cost of acquisition, this is our gain. So this is our gain amount, this is our sale amount. If you want to make 35 lakh 0, you have to invest 50 lakh, you have to invest the sale amount. If I invest 50 lakh, 35 will be exempt, nothing will be taxable. If I invest 40 lakh, that means I have not invested the net sale consideration. That means full 35 lakh will not be exempt. But will it be proportionate? No. This is very, very stupid, but this is the formula. Cost of new minus cost of old, cost of new minus cost of old, cost of new asset minus cost of old asset. So cost of new asset is 40 lakhs, this is your investment new asset. Cost of old asset was 15 lakh, and 25 will be exempt, and from 35, if you take 25 exemption, 10 lakh will be taxable. If I invest 30 lakh, so cost of new 30, cost of old 15, 15 lakh will be exempt, 20 lakh, 35 minus 15, 20 lakh will be taxable. So if entire net sale consideration is invested, entire capital gain will be exempt. Otherwise, it is not proportionate. It is cost of new minus cost of old, cost of new minus cost of old. That's your concept of capital gain. Next concept, withdrawal of exemption. Trust which will not get exemption, even if you fulfill condition, your benefit will be taken. Any trust operating for private religious purposes, so no benefit to general public, exemption will be withdrawn. Any trust working benefit for a particular caste, community, creed or religion, again no benefit to public, exemption will be withdrawn, except if the trust is working for scheduled caste, scheduled tribe, backward class, women, children or senior citizens. Some examples I have put before you in the form of pictures. Any trust which is working for the benefit of scheduled caste, scheduled tribe, backward class, women, children, senior citizen, then in that case the exemption will not be withdrawn. Anything else, exemption will be withdrawn. If the trust is working for benefit of specified person, who are those people? Author, founder, manager, trustee, anybody who has contributed more than 50,000 or relative of the above, then exemption will be withdrawn. Again, there are exceptions. If the total benefit is up to 1000 rupees per annum, then exemption will not be withdrawn. And if it is an educational or medical trust, then only the benefit taken will be added in the taxable income. Keep that amount aside, calculate the other income, 15% application, accumulation, everything, find out the total and add the benefit taken. The benefit taken will be added. Any income from non-specified investment, anything which is not in 11 subsection 5. If you invest there, for example, trust buying shares of a private company, trust making investment in partnership firm, any such income will also, like your this case, what will we do? On other income, we calculate 15% application, accumulation, everything, and in this we will add your non-specified investment. If you don't keep separate books of account, that means you are violating condition, exemption will be withdrawn. If your business is not incidental, then again you are violating condition, exemption will be withdrawn. If your form 10 is filled belated, accumulation benefit is available only if the form 10 is filled on or before the due date of return filing. So if your form number 10 has been submitted late, if your form number 10 has been belated, then your benefit is going to be withdrawn. But which benefit? Only accumulation. So 15% application will be allowed. Okay, only accumulation will be withdrawn. Only accumulation will be withdrawn. Any trust which falls in advancement category, then there are conditions, no? Commercial activity should be related to charitable activity. Commercial receipt should be within 20% of total receipt. If you have violated any of the conditions, then in that case, you will lose exemption. And if you have any kind of anonymous donations where you have not kept the identity of the donor, so that will also be taxable. These are the cases where a charitable trust will lose its exemption. In other words, the trust will have to pay tax in the current year. But the first 4 cases, which 4 cases? Private religious purposes, particular caste community creed, benefit of specified person and non-specified investment. Private religious, particular caste community creed, specified person and non-specified investment. They are big crimes, such big crimes, then in point 1 to 4, even your registration can be cancelled. Difference is, if you lose exemption, you lose only in this year. But if your registration is cancelled, you will lose exemption forever, lifetime. You are not a trust anymore. That's the difference. So even your registration can be cancelled by the CIT. These are the cases where your exemption will be withdrawn. Now we come to the next provision of anonymous donation. Meaning is very easy to be understood, that where the identity of, that is the PAN or the Aadhaar or name address, is unknown, then such a donation will be called anonymous donation. Anonymous donation will be taxed at a flat rate of 30% SCHEC if applicable. But this section 115 BBC will not be applicable to 2 trusts. Which? Wholly religious, not applicable, because they will always have the system of donation box. So it is not possible to keep identity. And partly religious, partly charitable, if the anonymous donation is received for other than education medical purpose. Other purpose. That means education medical it will be applicable. Other purpose it will not be applicable. Or you may put it this way, that flat 30% will be applicable in which 2 cases? Any trust which is wholly charitable, it will be applicable. And in partly category, if it is received for education medical purpose, then it will be applicable flat 30. Let's divide our trusts in 3 categories. Wholly religious, wholly charitable and partly religious, partly charitable. Wholly religious, flat 30 115 BBC, not applicable. Wholly charitable, flat 30 115 BBC, applicable. And in partly, check, is it education medical? Then flat 30 applicable. And is it other purpose? Then flat 30 not applicable. Check the purpose, accordingly decide whether flat 30 will be applicable or not applicable. That's the summary also. That same chart which I was speaking orally is also made here in the book. Wholly religious not applicable, wholly charitable applicable, and partly check, education medical then applicable, otherwise not applicable. And how will you calculate this? You will have to separate. Of course, every time we have special rate we separate. Like if we have casual winnings we have to separate. So take anonymous donation separate, take other income separate. Obviously, from the other income, we will be getting 15% application, accumulation, everything. And here we will not be getting. Anonymous donations will be taxed at flat rate of 30%. But before we apply flat rate of 30%, we are going to get one deduction. We are going to get one deduction. What is that deduction? 5% of the total donations. When they say total, first of all, they are saying donation. When they say donation means business income, property income not covered. Only donations will be covered. What are they saying? Only donations. So we will cover which donations? Normal donations. We will cover anonymous donations, and we will cover, earlier we were not covering because the law is silent, but as per institute suggested answers, corpus will also be covered. But we will take only donations, not business income, not property income, not capital gain. 5% of total donation or 1 lakh, whichever is higher. This is important because it is a tax benefit. People may think it is whichever is lower, and you may go wrong, but it is not lower, it is whichever is higher. So 5% of total donation or 1 lakh, whichever is higher. 5% of total donation or 1 lakh, whichever is higher. Subtracted, and only on the balance you will apply flat 30. So your anonymous donation fully will not have flat 30% tax. From the anonymous donation, we will give you a deduction. What is that deduction? 5% of total donation or 1 lakh, whichever is higher. 5% of total donation or 1 lakh, whichever is higher. And after taking that deduction, we will apply flat 30 on the balance amount after taking that deduction. And now this amount which got subtracted here, there is an amount which we subtracted here. This is the amount that we subtracted here. The amount that we subtracted here will be added in our other income. When we are subtracting here, does not mean it will go fully untaxed. Just because we are subtracting, it does not mean that it will go fully untaxed. Whatever we are subtracting here will be added. But where will it be added? The amount that is getting subtracted from the anonymous donation will be added in your other income. It won't go untaxed. It won't go untaxed altogether. We don't want to apply flat 30%, but we will apply normal rates. So it will get added in the other income. And that's the confusion. Here the law is completely silent. The law just says amount subtracted from anonymous donation will be added to your other income. But other income where? You add it here at the top or you add at the bottom. If you add at the top, on this amount also you will get 15% application accumulation. And if you add at the bottom, that means you have taken everything 15 application accumulation, just add and your taxable income will arrive to tax at normal rates. This is a big confusion because the law is silent. The law just says there is an amount which you subtract from an anonymous donation. First of all, which is that amount? 5% of total donation or 1 lakh, whichever is higher. That amount which is subtracted, subtract that and apply flat 30 on remaining. Chalo, that's done. Anonymous tax calculation is done. Now add the amount subtracted in the other income. Add this amount subtracted in the other income. But at which place? To add it in the other income, there are two places, top or bottom. Historically, when institute used to give answers, institute used to add at the top, and in the note they used to say that even if you have added at the bottom, we will give you marks because the law is silent. And then they ask this question in MCQ, calculate tax of the trust. Now, when you have to give in MCQ, it can be only one of the answers. Either you add at the top or at the bottom. Because the income only will change. If you add at the top, you get 15% exemption. So, this amount only will change. And institute gave the answer based on this place. In fact, this was not even in the options of the MCQs. So, though the law is silent, going by what ICAI said, this amount which is subtracted from here, we will add at the top over here and then give 15% application accumulation, everything. Total donation, as I already told you, normal plus anonymous plus corpus. The amount reduced from anonymous donation and added to other income can be added at the top or at the end, at the bottom. The act is currently not clear, and as per earlier ICAI subjective answers, both options are allowed. But in MCQs, ICAI has added at the top and given 15% benefit. I have already spoken about that. Last concept of charitable trust, section 115 TD, exit tax. The moment you become non-charitable, that means you stop your charity, you have to pay like a penalty for stopping penalty. For stopping, not penalty, like a penalty for stopping charity, slip of tongue. Like a penalty for stopping charity, you will have to pay a one-time tax, where basic rate will be 30, compulsory surcharge like buyback tax, like 115 BBE, compulsory surcharge 12%, HEC 4%, effective rate being 34.944 in addition to normal tax. You have stopped charity, from tomorrow you will pay your normal tax, but as a penalty pay a one-time tax of 34.944. You did charity, that is not important. You are stopping charity, that is important. Use Google Lens to find out what was the exact dialogue. I don't have that much time to discuss with you. 34.944% is going to be the rate of exit tax. So over and above your normal income tax, there will be a one-time tax 34.944 on accreted income, net worth, assets minus liabilities. How will you calculate this accreted income? For immovable property, you will take FMV or stamp duty value, whichever is higher. For listed securities, you will take average of highest and lowest on the valuation date. Whichever date you stop charity, we have a table in which we will find out the valuation date. But on that date, if there was no trading, no problem. Last date when trading took place. So immovable property, FMV or stamp duty value, whichever is higher. For listed securities, valuation date, average of highest and lowest. And if no trading had taken place, then last trading date, average of highest and lowest. For unlisted securities, merchant banker will do the valuation. But there are three assets on which there will be no exit tax. One, any asset acquired out of agriculture income, no exit tax. Any asset for which exemption was not taken, maybe because you were not a charitable trust at that time, for whatever reason, exemption was not taken, then on that asset there will be no exit tax. And in case of dissolution, dissolution means you are stopping charity, but whatever assets you have, you should transfer that to another trust within 12 months from the end of the month of dissolution. Whatever assets you have, transfer it to other trust within 12 months from the end of the month of dissolution. On those assets there will be no exit tax. So if within the time there are some assets which are not transferred, whichever asset you transfer, no exit tax. But any asset which you don't transfer within the time, there will be exit tax on those assets. So assets which are transferred, no exit tax. Assets which are not transferred, exit tax within the given time, 12 months from the end of the month of dissolution. So three assets, no exit tax. Agriculture income asset, asset where exemption was not taken, and assets transferred within the time limit in case of dissolution. On all other assets, there will be exit tax on the basis of the valuation given here. But exit tax is not only on the assets, it's on the net worth, on the accreted income. So from assets, we will subtract our liabilities, fair market value of liabilities. Obviously, we know that corpus is like capital, reserves, provision for tax. These are not a part of liabilities. These are provisions, these are reserves. This is the corpus fund of the trust. They are not liabilities. When we say liabilities, we mean outsider liabilities. So these things will be excluded, and on that net accreted income, you will be paying 34.944% as your exit tax as a penalty for stopping your charity. The tax has to be paid within 14 days, otherwise 1% per month or part of a month interest will be levied. Part of a month means one day will be counted as 1 month, and if there is complete failure, then the trust as well as principal officer both will become assessee in default. Same as buyback tax, trust and principal officer assessee in default. And now finally, we have the 5 situations where exit tax will be paid. Situation 1, if a trust does modification of objects, it should apply for fresh registration within 30 days, but it did not apply. Then we will calculate what is going to be our, this column is basically the valuation date. We will take assets and liabilities ka value from which date? From the date of modification of objects, and pay that exit tax within 14 days from the end of the previous year. If a trust does modification and it applies, but this time the CIT denies, then again on the date of modification, we will value the assets and liabilities and pay, not right now, check, has the trust appealed? If you appeal, it is possible that you win the appeal, then you don't have to pay exit tax. So the only 2 cases where you pay exit taxes, if you don't appeal or if you appeal and you lose, then exit tax is payable. If you don't appeal, then 14 days will be counted from expiry of time limit to appeal, and if you appeal, then 14 days will be counted from the copy of order in which you have lodged the appeal, and that can go to ITAT, High Court, Supreme Court, any level. From there we will count 14 days. If a CIT cancels registration of the trust, then we will value assets and liabilities on the date of cancellation, because that is the date from which you stop being a trust, but don't pay right now. Check. If the assessee does not appeal, that means you have lost the case, you are liable to pay exit tax from 14 days from expiry of time limit to appeal. And if the trust appeals, no need to pay exit tax. Wait. You win the appeal, no exit tax. You lose the appeal, then 14 days from getting copy of that order in which you have lost the appeal. Next, if you merge with a non-charitable entity, then on the date of merger you value your assets and liabilities, and here it was a voluntary merger, so there is no question of appeal. Within 14 days from merger, pay your exit tax. And last, in case of dissolution, not all assets but only the assets which are not transferred within that time, 12 months from the end of the month of dissolution. In case of dissolution, only the assets which are not transferred, that value of those assets we will take from the dissolution date. Payment has to be done later, but valuation has to be taken from the dissolution date, and payment has to be done after that time limit expires. This time limit 12 months from the end of the month of dissolution. From that, within 14 days you will have to pay, and that is your concept of exit tax. That's our chapter, assessment of charitable and religious trust. Let's go ahead. Very small chapter. Assessment of political parties. Guns, drugs, property, sab chota dhanda, asli dhanda, politics. I'll translate, don't worry. I know there are South Indians also watching the lecture. This everyone understands, huh? But dialogues from movies and web series everyone will understand. Lecture is kept in Hindi. Bola, no sir, we don't understand Hindi. And sir, we have to give exam in English, so talk in English. Very good. Thank God you don't tell me to talk in Telugu or Tamil or Malayalam. Thank God. So let's stick to that language in which we have to give our exam. Real business, politics. Political parties will be getting tax exemption under section 13A. What is a political party? Political party is registered under section 29A under the Representation of the People Act 1951 with the Election Commission of India. That way you pay politics in your family also. You've done that. You played politics, no? But that does not mean that you come in 13A. To come in 13A, you have to be a registered political party. And that is with the Election Commission of India. You have to register yourself. Then only you are a political party. And what are the conditions? Condition, maintain books of accounts and documents. Obviously, with books of accounts, you have to get it audited. File your return on time. See, trust, political party, SEZ, everywhere, return has to be filed on time. If you receive more than 2,000 in the form of donation, it has to be received through the allowed modes: account pay check, account pay draft, electronic clearing system through bank account, other prescribed modes, or electoral bonds. What are electoral bonds? Pay check and buy from a bank, donate it to a political party, and that political party can redeem it only in account. So the donor can buy in check only. It has to be given to political party, and political party will redeem it in the account only. Without the identity of the donor, we can give political donations, and it will still not be black money, because the purchase of bonds and redemption of bonds will be from the bank account only. So that has to be allowed. So there are 4 allowable modes: account pay check, draft, electronic mode, and electoral bonds for any donation more than 10,000. In other words, cash will not be allowed. And anybody who is donating more than 20,000, donation is also, just like charitable trust, biggest source of income for political parties also. So maintain records of all contributions, all donors, names, addresses who have given you more than 20,000, and once the conditions are fulfilled, the political parties can enjoy their exemption. Enjoy. What are the conditions? Quick recap. First, you have to be a registered political party. Then what are the conditions? Books of accounts, audit, file return on time, more than rupees 2,000, it has to be in the 4 allowable modes, and more than rupees 20,000, maintain records of the donors. Of course, excluding electoral bonds, because electoral bonds do not involve the human being, they just involve the bank where one person buys and the political party redeems it. Once conditions are fulfilled, house property, other sources, capital gain, voluntary contributions and donations, they all will be exempt. All these incomes, voluntary contribution is a part of IFOS, but being the biggest source of income, I have written it separately. Of course, salary is not possible, it is an artificial person, and PGBP we all know is always going to be taxable. So PGBP always taxable, salary not. Whether you fulfill conditions or you don't fulfill, PGBP is always taxable. Always. Even if you fulfill, PGBP will be taxable. Salary is not possible only. If you fulfill conditions, all other incomes will be exempt. Electoral bond ka meaning, which I explained, is also written over here. Whoever gives donation to political party will be eligible for deduction under chapter 6, 115 GGB, sorry, 80 GGB for corporate assessee, 80 GGC for non-corporate assessee. 100% deduction will be allowed for company under GGB, for others under GGC, but the donation has to be in a mode other than cash. Cash donations, you will not get any Chapter 6A deduction. This adjustment always comes in the PGBP sum. Donation to political party is given. You have to disallow in PGBP. Cash, check, anything you have to disallow in PGBP. Add back in PGBP. And then in chapter 6A, if it is cash, don't give deduction. If it is by a mode other than cash, then you will get chapter 6A deduction. That was our chapter, assessment of political parties. Now let's go to electoral trust. What is electoral trust? It will receive money from people and it will provide funding to political parties. Electoral trust is a trust approved by CBDT in accordance with the scheme made by central government. The whole reason or idea behind creation is that we will give donation to electoral trust and electoral trust will give donation to political party. And till the time parties don't need funds, the electoral trust may invest it somewhere and earn some other income also. Voluntary contribution, that is donation received by electoral trust, will be exempt. That means one thing you should be clear. Any other income is always going to be taxable. Just like for political party, PGBP is going to be taxable. For electoral trust also, other income is always going to be taxable. The exemption is available only for voluntary contributions. It is not going to be available for other incomes. And what are the conditions for this also? First, it functions in accordance with the rules made. It has to function according to the rules. Second, at least 95% of current year donation plus brought forward surplus. See, last year also you must have received donation, some amount you must have spent. There must be some surplus, no? Current year donation plus brought forward surplus. Current year donation plus brought forward surplus. At least 95% of current year donation plus brought forward surplus should be distributed to political party by the electoral, cancel this one, by the electoral trust to a party which is registered. At least 95% should be distributed. Then only the exemption is going to be available. Some statistics are given here if you are interested in reading them. Only voluntary contributions are exempt, other income always taxable, I told you already. And to save the donors, donors were earlier giving donation to political party. Now the donors will give donation to the electoral trust. To save the donors, we are going to extend 80 GGB GGC for donation made to electoral trust also. So whether you give donation to political party or electoral trust, as a donor, you will get 80 GGB for companies, GGC for other assessees, 100% deduction of the donation made. Of course, it has to be by a mode other than cash. By a mode other than cash. Any donation made to political party or electoral trust will be allowed as a deduction under 80 GGB and 80 GGC for corporate and non-corporate assessee respectively, but only if it is made in a mode other than cash. That was our chapter, electoral trust. Let's then continue. We are now going to go to a very, very important chapter. The next chapter, chapter number 15, MAT, that is minimum alternate tax, section 115JB, governing the company, which says, governing the section which says every company. Section 115JB, governing the chapter which says every company has to calculate normal tax on NTTI. So calculate NTTI heads of income, calculate normal tax, add surcharge HEC, calculate the total tax liability. And then you have to calculate one more income called book profit. On that book profit you apply 15%. Add surcharge HEC as applicable here also. You will get one normal tax on NTTI and MAT on book profit, and you have to pay higher of the two. Every company has to pay normal tax or MAT, whichever is higher. The tax liability of a company is normal tax or MAT, whichever is higher. So the four calculations will be normal income, normal tax, book profit, MAT. Normal income, normal tax, book profit, MAT. And normal tax or MAT, whichever is higher, will be your liability. The four calculations are normal income, which is based on volume 3 heads of income. Normal tax rates I will give you, book profit calculation we will learn, and MAT rates 15%, but what is surcharge HEC we will learn all that. The liability of a company will be normal or MAT, whichever is higher, but MAT is not applicable to the following 5 companies. When we say every company, it means public, private, listed, unlisted, foreign, domestic, non-domestic, everyone. And when we say company, means we are going to, in this chapter, we are going to cover only companies. That means individual, HUF, AOP, BOI, LLP, all are not going to get covered. This chapter will be applicable only to companies. But 5 companies will not be having MAT. Which are the 5 companies on whom MAT will not be applicable. One, a company which is in the business of life insurance, because they already have a concessional tax rate of 12.5% of profits, and if we apply MAT on such companies, that means they will be made to pay 15% tax, then this 12.5 will become base. So life insurance company not applicable. Second, foreign company with which country India has a DTAA and that company does not have a permanent establishment in India. So normally foreign companies will have MAT, but if there is DTAA and the company does not have PE, no MAT. Foreign company and with that country India does not have a DTAA and that company is not required to register under any law in India, then MAT will not be applicable. Foreign company which has opted for these sections, these are optional presumptive taxation sections. So non-resident shipping company, airline company, those companies, if they opt for presumptive, they will not have books. Because they don't have books, they cannot compute book profit. So MAT will not be applicable. And domestic company, if it opts, this we did in the introduction class also, if it opts for the new taxation regime, one thing which is common in all the four sections of new regime, BAA, BAB, BAC, BAD, that MAT, AMT not applicable. So companies are covered under MAT not applicable and other assessees are covered under AMT, that will not be applicable. 5 companies MAT not applicable. Life insurance company, foreign company, yes DTAA, no PE, foreign company, no DTAA, no registration in India, foreign company presumptive taxation only if opted, and finally domestic company if new taxation regime opted. These 5 cases MAT will not be applicable. Other than this, any company, so only company not individual HUF, and any company listed, unlisted, public, private, all companies will have MAT, and normal income, normal tax, book profit MAT, normal tax or MAT, whichever is higher. We will first go and learn the tax rates as per normal provisions with surcharge HEC, then we will go and learn the MAT rates, and then we will learn the calculation of book profit. The normal tax rate first for domestic company for the previous year 21-22, which we did not study in introduction chapter, is going to be a flat rate of 30%. What is the tax rate of companies in our country? Flat rate of 30%. However, if your turnover 2 years ago, so if you are checking 21-22 as your year, then you don't have to see turnover of this year, you don't have to see turnover of last year, you have to see turnover 2 years ago. If your turnover of 19-20 is up to 400 crore, then it will be only 25%. So basic tax is going to be 30%. However, if your turnover in 19-20 is up to 400 crore, then it will be 25%. Basic tax 30 or 25. So if the condition is fulfilled, you take 25, otherwise it will be 30. That will be basic tax. Rebate of course not applicable because rebate is only for individual. Surcharge up to 1 crore, no surcharge. So for companies, firms, LLPs, surcharge will start only after 1 crore. Only individual HUF, AOP, BY, AJP surcharge starts after 50 lakh. Your surcharge will start only if income crosses 1 crore. After 1 crore, for partnership firm it is 12%, for individual it is 15%, but for domestic company it will only be 7%, and after 10 crore it is going to be 12%, and HEC will be always 4%. So surcharge will be 0, 7 and 12. Income up to 1 crore 0, more than 1 up to 10, 7, and more than 10, 12%, HEC always 4%. However, I am not taking you to non-domestic companies right now because we have been given the new taxation regime. Briefly, you already are aware about the conditions, just to tell you the rates and the applicability. So we have two sections, 115 BAA and BAB, where we have been given basic rate as 22 and 15 respectively. Surcharge is compulsory. This is similar to 115 BAD for cooperative society. Compulsory surcharge. In fact, here the rate also is same. Compulsory surcharge 10%, compulsory HEC. Effective tax rate under 115 BAA will be 25.168% and effective tax rate under 115 BAB will be 17.16%. So any company opting for new regime, it will have two possibilities. BAB is only for manufacturing companies, so that more conditions are there. Otherwise, BAA is available for all the companies and the rate will be drastically reduced. In BAA, the rate will be only 25.168% all inclusive, and in BAB, it is going to be 17.16 all inclusive. And we all know if new regime is opted, there won't be any MAT. Let's see the conditions. Only domestic company. So here it is mentioned domestic. BAB it is mentioned. BAD cooperative society resident. BAC it was not mentioned. You will not be allowed to give. Same thing. You will have to forego your tax benefits, which 10 AA benefit, additional depreciation, all these deductions of PGBP. Here you have to forego 35 2AB also. There are total 7. You have to forego 5 because there are only 2 which are allowed in the new regime. 35 AD specified business deduction, agriculture extension, skill development, All these deductions have to be foregone. Any deduction of chapter 6A also has to be foregone. Chapter 6A not available in new regime except job creation, that is 80JJAA. If there is any dividend income, that will be allowed, and there is 180 LA for IFSC. Only these three deductions will be allowed, otherwise no chapter 6A. And with respect to these deductions, if there is any brought forward amount, that will also lapse. All these are same conditions similar to 115 BAC BAD that we have already studied. Option should be exercised on or before the 139(1) due date, and once taken cannot be changed. BAC was the only section where option can be changed. In the other sections, the option once taken cannot be changed. And don't forget, the special rates will also apply in new regime. So you will divide your income into normal and special. Normal income you can take old or new, but special income will always go in special rate. So very basic conditions: domestic company, leave your tax benefits and exercise the option on or before the due date of return filing. Let's talk about the conditions of 115 BAB. This is also only for domestic company. You will have to leave all those tax benefits same. SEZ, 10AA, additional depreciation, 33AB, ABA, all scientific research except two which are allowed, 35(1) and 35(2). Your specified business, agriculture extension, skill development, chapter 6A, brought forward losses about all this. All this will be disallowed. Same three exceptions are also prescribed over here. Option has to be exercised on or before the due date of return filing, and once exercised cannot be changed. This appears same, but there is one catch here. This option has to be exercised before your first ROI. In the other sections, BAA, BAC, BAD, it was optional. Right now you are in old. Whenever you want, you shift to new. You can stay in old for some years, and after that you can shift to new. You can take all these deductions by remaining in old. Once all these deductions are over, then you shift to new. But in BAB, when you file your first return, you decide old or new. If you take old in that, lifetime old, because it has to be taken in the first. And if you take new in that, then lifetime new. Whatever you take, you have to take in the first return. If you take old, then lifetime old. If you take new, then lifetime new. In 115 BAB, the option has to be decided and taken in your very first return of income. Thereafter, changing of that option is not going to be possible, is not going to be available. There are more conditions. This is for new company. So that is why we are putting the rule of first ROI. Otherwise, if it was old company, then first ROI must have been filed long ago. This company is incorporated on or after 1st October 19 and commenced manufacturing up to this date, 31st March 23. This should be only in manufacture business, and there should not be, you cannot have multiple business. Only manufacture, no other business. Not splitting up or reconstruction of existing business, same condition as SEZ. Maximum second and 20% of total plant and machinery, local. So new will be imported will be counted as new only. Maximum second and local plant and machinery, 20% of total. Same condition as SEZ. It should not be using any building which was earlier used as hotel or convention center. Anyways, it's a manufacturing company, and manufacturing will exclude the following items. Following things will not be covered in the definition of manufacture. They may be manufactured for general knowledge purposes, but for 115 BAB, they are disqualified. What? Development of computer software. You cannot say, sir, I manufacture software. Not eligible. Mining, not eligible. Big marble blocks you are cutting into size, slabs, tiles, etc. Not converted into or not qualified as manufacture. Putting gas into cylinder, you know, in cylinder it is liquid gas, then it comes out in the form of gas, LPG, liquefied petroleum gas. It will not be treated as manufacture. Printing of books, paper converted into book may be manufacture, but for this section, disqualified. Sir, what do I manufacture? I manufacture movies, cinematographic films. Raj Kundra. I manufacture movies, not eligible, disqualified. Any other notified business, these businesses will be disqualified from the definition of manufacture. They will not be treated as manufacture for the purpose of 115 BAB. And if there are super profits, see, there may be assessees who have two businesses. One is this 115 BAB, one is any other business. If you observe the tax rate of 115 BAB, it is a ridiculously low rate, 17.16. So people will purposely show more profits in this business. And if that is the case, the AO can recompute the profits and find out if there is any falsely shown profit over here only to claim the concessional benefit of. Supposingly, I have got black money, crores of rupees of black money. Normally, if I offer to tax, then I will have 30% tax, 37% surcharge, 4% HEC, 42.744% all inclusive. Instead of that, open a manufacturing company, dummy manufacturing activity, and show all that black money as revenue of that company. Show that as profit. And the tax rate is only 17.16. AO is asking, in the first year, no one can make so much profit. There is something wrong here. The AO has the power to recompute your profit. And how will you calculate tax? First of all, if there is any chapter 12, you separate. We are all clear that chapter 12 will always apply separately. For your other income, you divide into business, where it is compulsory only manufacturing, no other income allowed. 17.16. Business income 17. This is the only income eligible. So you may be having other income like house property, other sources, interest income and all that. That will be taxable at 25.168. Because if you observe carefully, a company which is fulfilling the conditions of BAB, so many conditions, has already fulfilled the conditions of 115BAA, and thus this company will be eligible for the rate of 115BAA for its other income. That will be 25.168%. And in case of the recomputed profits, if the AO finds out that there is something wrong, you are showing unnatural profits, then that will be taxed at 30% plus surcharge of 10% and 4%, because in this section there is compulsory surcharge. So special rate will be separate. Other income, only business will be eligible for 17.16, and then house property, other sources and short term capital gain, all other incomes will go in BAA rate, but recomputed profits will go in 30% plus surcharge and HEC rate. And as I already told you, BAA can be opted at any time, but BAB has to be opted in the first year, otherwise it will not be available forever. Now let's talk about non-domestic company. First of all, there is no new regime, only old regime. And what is the rate? Only one rate. Foreign company in India will pay flat rate of 40%, very high rate, and thus surcharge is less. No rebate because it is a company. Up to 1 crore, no surcharge. Between 1 and 10, 2%. More than 10, 5% surcharge. So it was 0, 7, 12 for domestic. Same thing is 0, 2 and 5 for non-domestic company. And of course, HEC will be added. HEC will be added at a rate of 4%. HEC will be compulsory. It will be added at a rate of 4%. These are the normal tax rates which will be calculated on NTTI, heads of income. Now we will calculate book profit, and on book profit we will apply MAT for domestic and non-domestic both. The basic MAT rate in India is 15%. What is the rate of MAT? 15. But any assessee operating from IFSC, then it will be 9%. So MAT also there are two rates, domestic, non-domestic, both companies 15, but IFSC 9%. If you observe surcharge, it is 0, 7, 12, 0, 2, 5, same rates. The amounts are also same, up to 1 crore, between 1 and 10, more than 10. So some are like, sir, same. No, not same. Here you have to see the amount of book profit. It is possible that your normal income is 80 lakhs. So here there is no surcharge, not crossing 1 crore. And your book profit is 1 crore 50 lakh. So here this surcharge will be applicable. So here your book profit is treated as your income, and thus the surcharge will be on the basis of your amount of book profit. So 0, 7, 12, 0, 2, 5, the rates are same, the monetary thresholds are same, but you have to see the amount of book profit, and HEC will be always added at a rate of 4%. HEC will be always added at a rate of 4%. Now we come to the learning of book profit. Starting point will be just like PGBP, net profit as per profit and loss account. But if it is a banking, insurance, electricity company to whom Schedule 3 of Companies Act is not applicable, no problem. Whatever is your applicable format, start with net profit as per profit and loss account. On the add side, we will have 15 adjustments. On the less side, we will have 14 adjustments. Add side, one by one. If debited means you have reduced your profit. If you have reduced your profit, then you will add it back. What are the points? First, income tax, including surcharge and cess, which are a part of income tax. DDT also under income tax. Interest also, but surprisingly they have missed the word penalty. So all these things are added in normal income also. In normal income, penalty is disallowed, but here they have not mentioned. In other words, if we have any penalty debited, in MAT we will not add it, only in normal we will be adding. Deferred tax liability will be added because deferred tax asset is also subtracted. Income tax refund also will be subtracted, but we will go to the less side after finishing the add side. Any dividend which is paid or proposed, it is not an expense, it is an appropriation of profit. Any provision, most important word in the next 3 points is the word provision. It is provision, it is an expected loss, it is not a materialized loss. You expect to suffer this loss, you have actually not suffered the loss. So provision for losses of subsidiary company, provision for diminution in the value of asset, and provision for unascertained or contingent liability. You have purposely created this provision and reduced your profit. Actually it is only an expected loss, so provisions will be disallowed. any expenses you have incurred to earn exempt income under section 10, 11 and 12. So on the less side, exempt income will be subtracted. If income is subtracted, then obviously expenses will be added back. Any kind of transfer to reserve, P&L to general reserve, P&L to dividend equalization, these are appropriations. So we will add them back. We will be adding depreciation as per books of accounts, because on the less side also we have depreciation adjustment. In NTTI, we add as per books, less as per tax. But here, as you know, we add as per books, less as per books, but excluding the revaluation depreciation. We want to disallow the revaluation depreciation. Then 10th point is basically not something that you have debited. It is not an expense. It is an income, and you should credit it to P&L account. But if you don't credit, then we will add it back. So what is the first 9 points? If debited, that means you have reduced your profit, add them back. But what is the 10th point? It's an income. You credit it. If you write in P&L account, then no adjustment. But if you don't write in P&L account, then you will have to add balance in revaluation reserve in respect of assets sold will be added back. Balance in revaluation reserve in respect of assets sold will be added if you have not credited. Under the calculation that I have given you for book profit, I have given some explanatory notes also. For example, there is no 30th adjustment. There are 15 points on the add side, 14 points on the let side, total 29 adjustment, no 30th. Come what may, we will not make any 30th adjustment. After we arrive at book profit, this figure, not a single rupee will be added or subtracted. This is the example that I have given for the revaluation reserve. For asset purchase for 10 lakh, journal entry is asset account debit to bank account 10 lakh. Then you revalue to 15 lakh. So asset account debit to revaluation reserve 5 lakh. Then you sell for 13 lakh. So bank account debit 13, asset account credit 15. P&L is showing a loss of 2 lakh. Now 10 lakh asset sold for 13, then actually it's a profit. Why is it showing a loss? Why is 3 lakh profit being shown as 2 lakh loss? Because 5 lakh is lying in revaluation reserve. So you should pass an entry, revaluation to P&L. Remove this 5 lakh. If asset is gone, then revaluation also should go. Pass this entry. If you pass this entry, that means you have credited. That means no problem, your profit is rectified. But if you have not credited, then you will have to put it. So this point J is explained here. This is your explanation of point J on, oh, I have already mentioned it. Point J on add side. This is your point J on the add side. This is your explanation. Continue on the add side. Next, any expense for share of income from AOP which is exempt under 86. On the less side, share of profit from AOP is subtracted. So of course, on the add side, expenses will be added. Likewise, royalty income taxable under 115 BBF, the income is subtracted on the less side. So the expenses here are getting added. If there is any foreign company which is earning these incomes, which incomes? Capital gain from securities or interest, royalty, FTS, or there is only one amendment here, dividend income. Interest, royalty, FTS or dividend. On these incomes, if the normal rate of tax is less than 15, normal rate as per income tax. For example, for interest, we have 20%, 5 and 4. So we are talking about 5 and 4, 20 not covered. Royalty, FTS, we have 10%. Capital gain also we have 10%. Dividend income also, we know that there are 20% cases and there are 10% cases also. Wherever the normal tax rate is less than the rate of MAT, then that income will be subtracted on the less side. Wherever normal rate is less than MAT rate, less than 15%, then the income on the less side will get subtracted, then the corresponding expenses will get added. We don't want to apply MAT on those incomes where normal income tax rate is less than 15. So we will subtract that income. Same is the logic here also. Normal tax rate is less than 15. It is only 10%. So subtract the income, add the expense. Subtract the income, add the expense. And the last 2 points are related to your business trust part. If you have shares in a real estate company and you get in exchange business trust units, at that time, whatever is the profit or loss in books, remove it. So if there is any profit, we have on the less side notional profit, you less it, and on the add side we have notional loss due to exchange or due to change in carrying value. Whatever is the profit or loss as per books, remove. How will you remove? Profit is credited, so remove by minusing, and loss is debited, so remove by adding. Whatever is the loss or profit in books of accounts, you will remove it, because the profit or loss will be calculated as per tax. And as per tax, what is the calculation? Selling price of units minus cost of shares. Selling price of units minus cost of shares. So that actual capital gains will be added, and if it is loss, then it will be subtracted. So notional loss add, actual profit add, and on the less side notional profit less and actual loss less. So first notional amounts, profit or loss we have to remove, profit by minusing, loss by adding, profit by minusing, loss by adding, and then actual profit or loss that we have to bring. So profit by adding and loss by subtracting. The last 4 points, 2 on the add side, 2 on the less side, are related to business trust. Whenever we get units of business trust in exchange of shares, or if the carrying value of unit changes, or if we sell the units, our books of accounts will show a profit or loss different from the actual amount as per tax. As per tax, the calculation will be selling price of units minus cost price of shares. Selling price of units minus cost price of shares, that will be the calculation as per tax. But whatever books show, remove. So remove the profit by minusing, remove the loss by adding, and whatever is the calculation as per tax, you incorporate. So add the capital gain as per tax and less the capital loss as per tax. Add capital gain as per tax and less capital loss as per tax. That's your 15 points on the add side, but coincidentally with the last 2 points, we have also understood the last 2 points on the less side. Let's talk about the other points on the less side. Any income tax refund, if income tax debited, income tax paid is added, then refund will be subtracted. But listen, interest on income tax refund is taxable. Interest paid is disallowed, but interest received is taxable. So when on the add side, we add income tax and interest, but on the less side, we will less only tax. The interest is taxable, so we will not minus it. The interest will remain in my book profit. I will not minus. Deferred tax liability was added, so deferred tax asset is going to get subtracted. If there is any relevant shipping income of a tonnage tax company, the actual income will be subtracted, because tonnage tax company may be opting for tonnage tax scheme, so it will pay tax on tonnage income. We don't want to apply MAT, then the actual profit will be subtracted. If there is a sick company and it is earning profit during sickness, that profit will be subtracted. Point E is that adjustment which comes always, any brought forward losses, any what? Brought forward losses, but as per books of accounts, because we are doing book profit. So brought forward losses as per books of accounts, we will take unabsorbed depreciation or other loss, whichever is lower, UAD or other, whichever is lower, UAD or other, whichever is lower as per books of accounts. And if the question only gives one, that means other is 0, then no need to subtract anything. Brought forward losses adjustment we are doing, we will take as per books of accounts because it is book profit. UAD or other losses, whichever is lower will be taken, and if one is given, other is 0. But there are 2 companies which will get both UAD and other loss, both, to promote or to encourage or to support these companies. Any company that has applied for insolvency under the IBC and the insolvency application has been admitted by the adjudicating authority. Only applying is not enough, it is admitted by the adjudicating authority. Then that company can take both loss and UAD. And if the board of directors is suspended by NCLT and new board of directors is appointed, I think this is 241 and 242 section of Companies Act 2013, you can refer the company law. For these 2 companies, we will add loss and UAD both. Loss and UAD. So normally we will take UAD or other losses, whichever is lower, UAD or other losses, whichever is lower. But for these 2 companies, we will take both. Then exempt income under section 10, 11, 12, exempt income we don't want tax, so we will subtract it, and of course that is why on the add side we have also added back the expenses. Any transfer from reserve, see, transfer to reserve is added, transfer from reserve will be subtracted. Transfer to reserve add, transfer from reserve subtract, but here we will exclude revaluation because that is considered in the next point. Transfer from revaluation will be subtracted, but it will be restricted to the extra depreciation due to revaluation. This will also be explained, this has also been explained by way of an example. So maximum restricted to extra depreciation due to revaluation. The depreciation that we have added was as per books of accounts, and the depreciation that we will less will also be as per books of accounts, excluding any revaluation depreciation. So add as per books, less as per books, add as per books, less as per books, but this less as per books will not include any revaluation depreciation. In net basis, the revaluation depreciation will be disallowed, but if you have transferred any balance from the revaluation reserve, then write that amount and cancel that disallowance. That is the explanation over here. I am not going into the detailed explanation because it is only the revision class. Share of profit from AOP BOI, which is exempt under section 86. That is why we are subtracting this share of profit, and that is why on the add side we are adding back the expenses. Same is the case of royalty income. No MAT, because normal rate is only 10%. So we don't want to apply MAT, and thus the expenses will be added. Any foreign company that has earned interest, royalty, FTS or dividend also with effect from EY 20 to 23(1) amendment. If the normal income tax rate is less than 15%, then we cannot apply, we should not apply. So subtract the income, and that is why we have also added the expenses. And last two are business trust related adjustments. If there is any profit in books, remove it by minusing. But if there is any profit or loss as per tax, then incorporate profit on the add side, loss on the less side. Already we have understood the first point to be noted, no 30th adjustment. Second point was with respect to point J. The next point, point number 3, is basically explanation of the 4 adjustment of business trust. So you purchase shares, pass the journal entry, exchange the shares, books are showing profit, but remove. This is that notional profit on the less side. Then if NAV is changing, again profit is being shown, adjust. This is notional, so adjust less. And by the way, if this was loss, then we would have added. So notional loss, add notional profit, minus. And when we finally sell it, when you actually sell the asset, at that time also your books will show some profit, because that is the difference between the book value and the selling price. But that is not your actual profit. So this also you less, and if it was loss, you add. Now calculate the actual profit or loss. Selling price 15 lakh, purchase price 10 lakh, the actual profit is 5 lakh. So you add, and if it was actual loss, then we less. So whatever books are showing, you remove, and whatever is as per tax, you incorporate. And now let's discuss the other point. First, compare both taxes, normal and MAT, whichever is higher is payable, compare at the end. Second, deferred tax, asset and liability are mandatory. There was a Supreme Court judgment, JK Industries, where Supreme Court said that deferred tax will not be taken, but that was overruled. Okay, so Supreme Court judgment says, ठीक है भाई, अब मैं चलता हूँ. Next, if transfer to reserve was not added, see, it is your duty to add transfer to reserve. If transfer to reserve has not been added, then transfer from reserve will not be subtracted. If transfer to reserve was not added, you made a mistake, then transfer from reserve will not be subtracted. There is no chapter 6A deduction in MAT provisions. We already saw that on the less side, 14 adjustments, there is no chapter 6A. And after arriving at book profit, you directly apply the MAT rate. There is no question of adjustment of a single rupee. CA report is compulsory, certifying correct computation of book profit. So congratulations, you get some more money only for signing. Next, Bombay High Court judgment, VK Lal Investment Company book profit covers all 5 heads. If you remember, 40B book profit of firms, this covers only PGBP, but the book profit that we compute under 115GB, that will cover all 5 heads of income. Apollo Tyres Limited, Supreme Court judgment. Can AO question the net profit figure? Of course, net profit is the starting point, so it will have an impact on the book profit figure. But can AO question? Can AO question? Can the AO question the net profit figure? That is the question. Supreme Court in the case of Apollo Tyres said, if the net profit is as per the company law, that means you followed the Schedule 3 etc. rules. If it was audited by a CA, if it was approved in the AGM by shareholder, submitted to ROC, if it is compliance of company law, approved by shareholder, approved by auditor, approved by ROC, then the AO cannot question the net profit as per profit and loss account. However, if any of the condition is not satisfied, then AO can question, because the case law is applicable only on the given facts that all the conditions are satisfied. If the facts are not same, then case law only is not going to be applicable. So can AO question? If these conditions are satisfied, then no. Otherwise, yes, he can question the figure of net profit. Again, a Supreme Court judgment, Royalty India Limited. Your liability is normal or MAT, whichever is higher, normal or MAT, whichever is higher. But you pay advance tax of which one? You pay advance tax on your liability. And what is liability? Whichever is higher. So is it possible that you have paid full 100% normal tax, but less than 90% MAT, and MAT is higher? Then you will be liable for 234B, 234C, any shortfall which is related to non-payment or less payment of advance tax or deferred payment of advance tax. Those interests will get attracted, because advance tax has to be paid on your liability, and liability is normal or MAT, whichever is higher. Next, Supreme Court judgment, Karnataka Small Scale Industries Development Corporation. Karnataka Small Scale Industries Development Corporation Limited. Example will explain everything, but if I have to tell you in short, taking set off is compulsory. Set off is not optional. If you are eligible for set off, you have to take it. You cannot postpone your set off. Set off is going to be compulsory, and even if the assessee is paying MAT, you have to take set off against your normal profits also. Next is the concept of MAT credit. Whenever MAT will be higher, MAT will become your liability, but the extra amount will become your credit. MAT is higher, MAT will become liability, the extra paid will become your credit. So total becomes 5. And now in future, whenever normal will be higher, you can utilize that credit, but maximum, even if you have 5 credit remaining, you can utilize only 3, because minimum this much you will have to pay. Whenever MAT is higher, credit will accrue, the extra paid because of MAT. And whenever normal becomes higher, you can utilize, but maximum you can utilize the difference. So in this example, from 12 lakh and 9 lakh, we can utilize only 3 lakh credit. Which 3 lakh we will take? We have to take the first 2 lakh, and then 1 lakh we will take from this, and the 2 lakh carry forward credit is from this 3, because we will follow FIFO, because the credit can be carried forward for a period of 15 years. So better to take this first. So we are taking 3 credit, out of which 2 is from this and 1 is from this, and the remaining 2 credit from 5, if 3 is gone, the remaining 2 is from this 3, because we are following FIFO. MAT credit is excess paid due to MAT and accrues whenever MAT is higher. Credit can be utilized whenever normal is higher. Maximum credit to the extent of bringing down the liability to MAT, and it can be carried forward for 15 years. Therefore, of course, we will follow FIFO. Next, the excess MAT credit due to difference in foreign tax credit will lapse. So I have given an example which will help everything. Fast, I will tell you about the example. Normal income 1 crore 15 lakh, book profit 4 crore 30 lakhs, and both amounts include 30 lakh of a foreign country, foreign income of 30 lakh, where foreign rate is 25% and no DTAA, because there is no DTAA and it's a domestic company. So you will be eligible for unilateral relief. So let's understand. First, we will apply the normal rate 30%, add surcharge, add HEC. That's the total tax as per normal. Here we will apply 15%, add surcharge, add HEC, total tax as per MAT. So this is normal tax, MAT, normal tax, MAT. If we go by the rule of whichever is higher, this becomes our liability and the difference becomes our MAT credit. So 71, 77, 560 minus 38, 39, 160, 33, 38, 400 becomes our credit. But this is wrong. Why it is wrong? This cannot be our comparison. You give unilateral relief from this, you give unilateral relief from this. After relief, you will get the final tax as per normal, final as per MAT, final as per normal, final as per MAT. And from these two, you choose whichever is higher. So at this stage, comparison is wrong. But in case we compare, we get this as MAT credit. Now let's calculate the unilateral relief. Income is this much and tax is calculated. That will give us the average rate. See, on this income, this is the tax. And on this income, this is the tax. So we will get average rate. You can check on your calculator. This is the average rate. Compare with foreign rate. So whichever is lower will become your credit. So in the normal, you will get credit at 25%. Unilateral relief. And in MAT, you will get at this. Apply on your doubly tax income. So you will get this as your unilateral relief. And after this, your final tax from 38, 39, 160, we will take credit of 750. This will become our final tax. From 71, 77, 560, we will take credit of 5 lakh 700. This will become our final tax. This is the correct stage for comparison. Comparing here was wrong only. You cannot compare. The correct place to compare will be this. And of course, this will be my liability. But now if you check your MAT credit, it is coming to 35, 87, 700. Why has this increased? Earlier it was 33, 38, 400. Now the difference is coming to 35, 87, because here these two amounts are different. The difference here, if you see 33, 38, 400 and 35, 87, 700, if you check the difference will be this difference only of 249, 300. So we will make the comparison here. We will make the assessee pay this liability. But we will not give him this much MAT credit. We will give him only 33, 38 MAT credit, because the extra credit is arising only because of difference in foreign tax credit. At one place, you got 750. At the other place, you got 5 lakh 700. And because of that, whatever extra MAT credit is coming, that will not be allowed. That will not be eligible. Excess MAT credit due to the difference in foreign tax credit will lapse. That will not be allowed. Clear? And then finally, in MAT, we also have Ind AS adjustments. Companies that have complied with Ind AS are required to do some extra adjustments. When I say extra means, first start with net profit, add side 15, less side 14. This is to be done. Ind AS adjustments are not a replacement of 29. They are extra over and above your 29 adjustments. With this, you will get book profit before Ind AS adjustments. And now we will do Ind AS adjustments. First, we will go and check OCI adjustment. OCI will be divided in two categories. Items that will be reclassified to P&L, no need to do anything in MAT because one day they will automatically come. But items that will not be reclassified from OCI, it will directly go to balance sheet. Then our responsibility to bring it. If it is credits, that means they are profits, then you add. If it is debit, that means they are losses or expenses, that means you less. So those items which will come in P&L, no need to do anything, but those items which will not come in P&L, you bring credits by adding, debits by lessing, but two things you will not take. Which two things? Revaluation surplus and investment in equity instrument, because they will be taken in the year of sale or disposal. So right now you will ignore. So what is your step? First finish 29 adjustments, then come to OCI. Ignore those entries which will be reclassified to P&L. Focus on those entries which will not be reclassified. In that also ignore two things: changes in equity instruments and revaluation surplus. Investment in equity instruments and revaluation surplus. Ignore those two, and all the other items, credits add, debits less. Credits add, debits less. These are OCI adjustments. If they come, they will carry 4 marks in your MAT sum. Then demerger adjustment, if at the time of demerger there is distribution, if there is any profit or loss, you have to eliminate it. How to eliminate? See, here we have to bring the profit or loss. To bring profit or loss, we have to add the profit less the loss. Add the profit less the loss. But here we have to remove. So how to remove? Less the profit, add the loss. The profit is credited, you less it. The loss is debited, you add it. Only if credited you will less, only if debited you will add. So because we have to, over here we have to remove them. And then we will also be having a 2-mark adjustment on transition amount. That is when you adopt Ind AS for the first time, then that year plus the next 4 years. So total of 5 years, whatever is your transition amount, 1/5 in 5 installments. If it is credit, that means it is profit, we will add. If it is debit, that means it is loss, we will less. So pick up your transition amount. In that, these two amounts are excluded. They don't fall in the definition of transition amount. So if the question is giving you capital reserve or securities premium minus, so pick up transition amount minus capital reserve securities premium, and the balance amount. If credit, then add 1/5. If debit, then less 1/5. We will be doing 1/5 over a period of 5 years. And the following 6 items will not come currently, they will come in future. This items which will be reclassified to P&L, it will automatically come in P&L, and the other will come in the year of sale. Same, investment in equity instruments, revaluation surplus, investment in property, plant and equipment at fair value, investment in joint venture and subsidiary, translation of foreign operation. Whichever year you sell it, in that year it will be taken care of. Right now it will not be taken. So what you do? Pick up your transition amount. Subtract if you have these 2. Subtract if you have these 6. They will come in future whenever they will come. Right now they will not come. And they will never come. So the common thing is this part and this part. Both has to be subtracted. From the transition amount, subtract these things. Remaining amount, divide by 5. Because we have to do it in 5 installments. And now, if it is a credit balance, add that 1/5 amount. If it is a debit balance, less that 1/5 amount. And there is this one small amendment that has taken place, actually not here, but that amendment is basically a transfer pricing amendment. So if there is any book profit which is being changed because of any secondary adjustment due to any AP or anything, then accordingly we can do some credit over here. But if you have not utilized the MAT credit, then only it is going to be available. So this is actually a transfer pricing amendment, so not relevant here. That was our all important chapter of MAT, that is minimum alternate tax. Now we go to the last chapter of volume 1, with which we will finish our first volume. Chapter number 16, AMT, that is alternate minimum tax. MAT is applicable only to companies. So companies were converting into LLPs. So they brought AMT for LLP. But then in the very next year, so this is 2012 and 13 that I am talking about, AMT was introduced for every person except company. And why company does not have AMT? Because company always also has MAT, already has MAT. So company will have MAT, other assessee will have AMT. Company will have MAT, other assessee will have AMT. Every person other than company also must pay higher of the two. What? Calculate normal income as per heads of income. Normal tax rates. Now you know all the tax rates. You know individual HUF, AOP, BOI, AJP, and partnership firm also we covered in chapter 11. Obviously, partnership firm LLP will come here. Companies will not come here. So calculate normal income, normal tax. Then calculate one more income. Like in companies, you are calculating book profit. Here you calculate adjusted total income. Calculate adjusted total income, and on that adjusted total income, AMT will be at 18.5%. So rate of MAT is 15%, but rate of AMT is 18.5%. Again, if it is a case of IFSC, it will be 9%. Surcharge, same rate. So for individual HUF, 10, 15, 25, 37. For firm, only one rate, 12%. But only you have to be careful about this, that here it will depend on the amount of ATI. So it is possible that this is 40 lakhs, but this is 60 lakhs. So here there will be no surcharge. Individual I am talking about, but here there will be 10% surcharge, because this will depend on amount of adjusted total income. Normal tax is calculated on NTTI, so surcharge will be on NTTI amount, but this is calculated on ATI, so on this, and HEC will come always at 10%. So we need to pay normal tax or AMT, whichever is higher. Normal tax or AMT out of the two, whichever is higher. And how to calculate adjusted total income? Start with net profit as per income tax. This is a big difference between MAT and AMT. In MAT, we start with net profit as per profit and loss account, but here we will start with NTTI as per income tax provisions, and only 3 adjustments. Only 3 adjustments, mama. Only 3 adjustments. What? Any SEZ deduction that you have taken, added back. Any 35 AD deduction that you have taken, added back, but net of the depreciation foregone. When you take 35 AD, you lose some depreciation, so only add the net benefit. And any income related chapter 6, so expense related will not be added, ATU will not be added, only income related, and in that also ATP, TTA, TTB will be excluded. So add these 3 things: NTTI as per tax, add SEZ deduction, add 35 AD net of depreciation, and income related chapter 6A, and you will get your adjusted total income. On this adjusted total income, apply 18.5%. Add surcharge will be depending upon this amount. Surcharge will depend on this amount. Rates are same. Individual HUF 10, 15, 25, 37, firm 12% only. But on the basis of ATI, add HEC, normal tax or AMT, whichever is higher. I have already discussed base amount is NTTI and not as per PNL. There is only add side and there are only 3 adjustments. Just following points to be noted. AMT is not applicable on whom? To company, because company has MAT. Any assessee who has not taken 10 AA, 35 AD or income related chapter 6A. Imagine, I don't have 10 AA, I don't have 35 AD, I don't have income related chapter 6A. That means all these figures will be 0. That means NTTI and ATI will be same. Then what is the requirement of AMT? AMT in such a case will not be applicable. Will not be applicable. Okay. If you have not taken any of these deductions, AMT not applicable. Any assessee opting for new regime, this is one thing that you are aware of since long ago. New regime means MAT AMT not applicable. New regime means MAT AMT not applicable. Any assessee falling in new regime, that means MAT and AMT will not be applicable. If it is an individual HUF, this is important to note, individual HUF, AOP, BO, AGP, whose adjusted total income is up to 20 lakh. This figure is up to 20 lakh. So we will not check this. We start with this, we add all this, and after adding also, if it is up to 20 lakh, you are such a garib, bhikari, bhuka, nanga person. We don't want to apply anything to you. If after adding everything, your adjusted total income is up to rupees 20 lakh, then AMT is not going to be applicable. But your institute plays games with students. They ask a question on firm LLP. Supposingly this is coming to about 10 lakh rupees. Total adjustments 5 lakh rupees. This amount is coming to 15 lakh rupees. Student is like, third, less than 20 lakh AMT not applicable. Finished. Immunity granted only to individual HUF, AOP, BOI, AJP. Firm LLP will always be liable. Firm and LLP will always be liable. Is that clear? So 4 assessees on whom AMT is not applicable. CA report certifying calculation of adjusted total income just same as book profit, and AMT credit also absolutely same as MAT credit, absolutely same, and including that foreign tax credit part, including that carry forward part. That's your chapter called alternate minimum tax, AMT, that is alternate minimum tax. With this we finish the first volume 1 of our portion. The first 16 chapters are hereby over in our 4th episode. There is no rule that I have to stop if I have finished volume 1. I have time, at least I will do the first chapter of volume 2. Volume 2 starts with discussion on assessment. So we have to study chapter 19 assessment procedure. But before studying chapter 19 assessment procedure, we need to learn a little bit about the department, about search, seizure powers. So we will learn income tax authorities and their powers, search, seizure and survey. Then we will peacefully go to our assessment procedure. So at least the first chapter I am doing right now. Okay. Income tax authorities and their powers. This is general introduction, not relevant. You can read if you want. I will directly start with hierarchy. CBDT will control the entire income tax department. Topmost, Director General, DGIT or Chief Commissioner, CCIT. CCIT, DGIT is the top. At this, we have Principal CCIT, Principal DGIT also. Second level, CIT, DIT, where again we have Principal also. Principal CIT, Principal. So, Principal post is only in CCIT, DGIT. First level, they are same rank. And second, CIT, DIT, same rank. And at the second level, we have this all important person called CIT Appeals, who is at the same level as CIT, junior to CCIT, but having the special power of reduction of tax liability of the assessee, which no one else has in the hierarchy. Next, we have the AO, Additional Joint Deputy Assistant ITO. These are the 5 levels of assessing officer. Additional Joint Deputy Assistant ITO. So, senior most IT authority is CCIT, DGIT, but senior most assessing officer is additional, and the 5 levels are Additional Joint Deputy Assistant ITO, Additional Joint Deputy Assistant ITO. Then we have, for recovery purposes, TRO and Inspector for clerical work. Meaning of AO, 5 levels of AO, I already told you. How will appointment be done? From CCIT to Joint Commissioner, appointment will be done by central government, and for lower authorities, CBDT, or CBDT can hand it over to CCIT, DGIT. The CBDT shall control all the IT authorities from top to bottom. Remember one thing, CBDT is the father, daddy, papa, abba, achan, abbu, pops of the income tax department. Anything CBDT will say, all officers from top to bottom, all officers are mandatorily required to comply with the instruction of CBDT, but subject to the overall framework of central government within the rules and regulations laid down by central government. Section 119, one of the most important sections of your entire syllabus, powers of CBDT. Whenever CBDT wants to exercise any of its powers, it will basically do it by issuing order, circular, notification, by releasing circulars to IT authorities. And this section 119 has divided circulars in 2 categories. Circulars which CBDT is allowed to issue, so smile on the face, and circulars which are not allowed to issue, so very sad. Circulars which are allowed and circulars which are not allowed. Let's see. What are the circulars which are not allowed? First, we cannot tell an assessing officer to finish off a particular case in a particular manner. Cannot tell the AO, disallow the expenses because he is my enemy, or allow the expenses because he is my friend. And we cannot interfere with the discretionary powers of CIT appeals, because when he is doing his appeal work, at that time he has the role of an independent judge. So we cannot interfere with the discretionary powers of CIT appeals when he is doing his appeal work. These 2 powers not allowed. But what are the powers allowed? CBDT can relax the provisions of filing of ROI, that means due date extension and all, assessment, reassessment, interest, penalty, any kind of fees. So you have belated return, you want loss carry forward, approach CBDT. You want to revise your return after the date, approach CBDT. You want to file a return after the date has gone, approach CBDT. Any kind of problem in your life, interest, penalty, fees, anything coming. If you don't have anyone in life, you have CBDT. This is a very popular Amitabh Bachchan song actually. Very popular Amitabh Bachchan song. Jiska koi nahi uska to khuda hai yaro. If you don't have anyone in life, you have God, no doubt about that. But in income tax, it is going to be CBDT. So any problem in life, approach the CBDT. If you want to file a belated ROI, if you want to claim a belated refund, belated loss carry forward, approach the CBDT. If you want any relaxation of the provisions of chapter 4 heads of income or chapter 6 say deductions, then approach CBDT. Whenever and wherever you are stuck in life, you may have God. God is there with us forever. His blessings are always there. But in income tax, it will be CBDT. So these are the powers available to CBDT. Points to be noted: CBDT circulars are binding on all IT authorities. IT authorities cannot go against the CBDT circular, but CBDT circulars are not binding on assessee. assessee can protest by filing a writ petition under Article 226 of the Constitution of India. So, as an assessee, if you are not comfortable with any of the CBDT circulars, then you can file a writ petition under Article 226 of the Constitution of India, and then the High Court will decide whether the circular is valid or not valid. CBDT circulars are also not binding on these independent organizations like ITAT, ITSC, AR. Simple. CBDT is the father of income tax department, not the father of the whole world. So, CBDT circular will be applicable only on its own children, not to everyone's children. Correct? If the circular is in favor of assessee, it will always be valid because authorities are not allowed to protest, and assessee will not protest if it is in his favor. But if it is in favor of department and it goes against the plain language of act or a Supreme Court order, then it will be invalid. You can file a writ petition and get the order from the High Court to declare the circular as invalid. Section 119 says that we will release a taxpayer charter, a set of rights and duties of AOs and assessees both, set of rules and regulations. A charter means a set of rules and regulations which will be followed by everyone, assessees, that is taxpayers, as well as the department, for smooth functioning of the law. Related to jurisdiction, totally ignore, because India has now slowly moved into something called jurisdiction free assessment, faceless assessment. Faceless assessment is an important part of assessment procedure, but I will not be covering that in the revision class, because already to explain the faceless assessment, because it is an amendment anyways, you should be interested in that. It's a newly introduced concept. I already have released a video, how will faceless assessment take place under income tax, explaining everything in detail from faceless assessment part. So, what you can do is, you can check that, and it's there in both languages. It's there in Hindi also, it's there in English also. How will income tax department work faceless? So, you can watch that video. Because it is an amendment anyways, it is recommended. Okay. Opportunity of being reheard. Whenever an AO changes, it is a part and parcel of day-to-day work. It can be because of promotion, transfer, retirement, death, any reason. AO changes, new AO will continue the work. He does not have to start fresh. Simple reason. It's change in officer, not in office. Officer has changed, office is same. So, old AO will leave and new AO will continue the work of the old AO. He will not start fresh. But assessee may ask for an opportunity of being reheard. Assessee may tell the AO, sir, there are some explanation that I gave to the old AO. Now I need to give you that explanation. So, assessee may ask for an opportunity of being reheard, but this can be given only if assessee is asking, not suo motu. This reheard can be done only if assessee is asking. It cannot be done suo motu. Section 130, faceless jurisdiction of Iit Authorities with effect from 1st November 20. Yes, it is an amendment, but you don't take it as an amendment. They have just said that we will make rules. They have actually not made rules. They have made rules only for doing assessment. Okay. So, they say that we will notify a scheme in the official gazette for exercising all the jurisdiction related powers. So, 120, 127, they are all jurisdiction, 124, and of course, change in officer also. To impart T, Modi ji no, T scheme, I call it the T scheme. We will bring a scheme for T, chai, garam chai, transparency, efficiency, accountability. Transparency, efficiency, accountability. I call it T scheme. We will bring a faceless scheme which will bring transparency, it will bring efficiency, it will bring accountability, and thus I will call it T scheme. What will happen? Eliminate the interface between income tax authority and assessee to the extent technologically feasible. That means faceless, no? We will eliminate their interaction. Optimum utilization of resources through economic of scale. What do you mean by this? Officer in Lucknow does not have any work. Officer in Mumbai is overloaded with work. No problem. The extra cases of Mumbai will be given to the officer in Lucknow through the computer. The officer will be given random cases. Any place officer and any place assessee. Need not be necessarily in the same city. Cases of Mumbai assessee can go to Lucknow officer if he is free. So, those resources which are lying idle can be utilized. That is called optimum utilization of resources, which also includes team based exercise of power. So, now one officer will not handle your case. There will be a team. Earlier you used to set one officer. Now you have to set a whole team. That also, for doing assessment separate team, for doing review separate team, for technical work separate team, for verification work separate team. There will be different units, assessment unit, technical unit, verification unit, review unit. There will be separate teams. How many teams will you set in life? Okay. So, that is what is meant by team based jurisdiction. Central government may by notification in the official gazette lay down that which certain provisions of the Income Tax Act may or may not be applicable, and once it is faceless. You know why these people had masks? Achha, by the way, do you know who they are? Chodo. Squid Games hai, Netflix pe. So that there is no corruption in the game. There should not be any corruption. So we will eliminate the interaction. But the bad news is that they just said that we will bring a scheme. We will bring a scheme. They have not brought any scheme. And this same content they have written at not one but multiple places. Multiple places in the law. So in section 133, 33B, 133C, these are all sections of search and seizure chapter. In these sections of assessment procedure chapter, right up to here, this is rectification, this is demand notice, this is intimation for loss, the work of CIT appeals, work of ITAT, the work of revision. Everywhere they have written this. Central government will notify a scheme for making it faceless. Central government will notify a scheme for making it faceless. Everywhere they have just written that we will bring a scheme, but they have not brought a scheme. They have brought scheme only for faceless assessment. So how will appeal happen, or ITAT happen, or how will all the other things happen? They have not brought a scheme. But they are basically doing what? It's a pilot project, trial project. The faceless assessment, which I told you that detailed explanation by way of a video is already there on the channel. The faceless assessment they are trying. If it works, then they will use the same system for all these other chapters of income tax also. So as of now, what they have done, we will make a scheme for all these different chapters, not just for IT authorities, but all these chapters. All these chapters we will make a T scheme. They have just written this one. They have not made the scheme. Scheme is made only for doing assessment. Faceless assessment. Faceless appeal, faceless rectification, faceless revision, faceless survey. They have not yet incorporated that. They said once it is successful, we will incorporate that for all these other things also. We just need to release a notification. We don't have to wait for the budget. Nirmala aunty, no, she does not wait for the budget. She brings notification whenever she wants. So we will bring notification and bring about the scheme. We are just now testing whether it is working or no. And the last section here, powers of IT authorities. What are the powers available to income tax authorities? These are powers copied from civil courts. Under the Civil Procedure Code of India, there are certain powers which are available to civil courts, and same powers, discovery and inspection. So ask question and check your answers. Enforcing attendance, they can call you whenever they want. Compelling production of books of accounts and documents, very important for tax computation. Issuing summons, that is calling you. Now you will say, sir, what is this and this? Here you can send someone on your, you can send a lawyer, or in income tax you will send a CA, but here you will have to personally be present because we need your statement on oath, and they will take custody. Impound means to take custody, to seize, to take custody of your books of accounts and documents if reasons are recorded in writing, and prior approval of CCIT, DGIT is taken for keeping it beyond 15 working days. So 15 working days they can keep it, and beyond 15 working days they have to fulfill two conditions. These are the powers of IT authorities, and that is your chapter number 17. First chapter of volume 2 is also hereby over. So we have done a good number of chapters. We finished charitable trust, political party, electoral trust, MAT, AMT, and now we also finished IT authorities. So I think that is good enough for the day. You should be able to digest also, and we need a fresh mind to do chapters like search, assessment and all that. By now I strongly believe that we are in the 4th episode. So all the students who did not have the book and now suddenly realize, oh my god, arey book chahiye. So by now I hope you have ordered. In all the lectures, in the description box I write the link of the website Coppergate Educate. So you can, if you want, I am not forcing you. I am going to cover the revision lectures from this book. If you think you need it, you take it. Otherwise you don't take it. I am not forcing anyone. I know my book is the best. I don't need to advertise for that. If you want, you take it. The link is provided in the description. So I hope you are getting a little comfortable. All those who are getting comfortable, let me act like a YouTuber now. So like the video, mention in the comment section, watch the video till the end. Okay, thanks for watching. Have a nice time, have a good night. We will meet each other for the next session tomorrow. Have a nice day, please. Have a nice night. Good night, please. Thank you very much.